Welcome back, everyone. This new video in the series of Forex in 5 minutes is going to be about setting your profit targets. So there are two main ways you can do that. Number one is you can use risk reward targets. This can also be percent targets. It's the same thing. If you're getting 2%, then it's going to be about, if you're risking 1% on a trade and you get 2%, it's going to be a 2-to-1 risk reward. It's the same sort of thing, but it's involved in using your risk management and then making sure you make the best out of that risk management. That is what using risk reward targets does. Then number two is you can use structure or levels as targets. So this would be where, for example, if we see some sort of trend line here or something like that, we may aim towards this trend line as our target because we're banking on the fact that maybe price may bounce down again from there. So we're not going to want to hold through. We could see horizontal levels. We could see we've got a major high here. So we'd aim up to this level as a target, things like that. Now, I'll get a bit more in depth into this now. We'll start with risk reward targets. And I quickly want to brush over why I don't count using pip targets in this. Now, pip targets can be used if they are used within the same risk reward bracket sort of target way of setting. But the problem with just using pips as a target is pips are a unit of measurement. They don't take into account risk unless you appropriate them towards risk reward targets. So what I mean by that is, for example, someone may say, oh, I made 100 pips on NZD/USD, and that could sound great. But if they risked 100 pips, if their stop loss was 100 pips, that's not that good. That's only a 1% gain if you're risking 1%. That's only a 1-to-1 risk reward ratio. Whereas if someone says, oh, I made 20 pips, you may think, oh, that's not that good. But if they only risked 5 pips to get to those 20 pips, they've got 4 times their risk. So pips are not great on their own. Risk reward ratios are better for targets. And what I mean by that is straight away, say we're entering here and we're looking for buys. Let's have a stop loss of 9 pips below and about 18 pips. This would be your risk reward ratio of 2 as your target. And you know that if you can sustain 1 to 2 risk reward ratios on your trades, and that's what you use for targets, you only need to win 4 out of 10 in order to be profitable. So if you won 4, it's 2 times 4, 8. And if you lost 6, 6 times 1, you're losing 6. So you're actually up 2% still, even though you only won 4 out of 10 trades. So very, very good. Using high risk reward ratios generally means that you have to win less in order to be profitable. Generally, if you try to push it too far, your win rate will drop, but that's about finding the sweet spot for you as a trader. So just with this, though, we're going to talk about, we use risk reward ratios as targets. You can also aim for like 1 to 3s, for example, is another common one. But this means that you'd need to win even less in order to be profitable. But again, as I say, if you're aiming for that further target, it means generally it can be less likely that you'll hit that far. It depends on your strategy. So, for example, based off this logic, we could say, oh, let's just go for 1 to 10s every time. That means we barely ever have to win in order to actually be profitable. But look how far you're then going to have to be aiming every time. Is it likely you're going to get a trade like this every time? No, it's not. So it's going to mean your win rate is much, much lower, etc. That can affect your psychology, all that sort of stuff. So risk reward targets are the first option. They're very, very good. I use risk reward targets in a lot of our strategy as well. The second is using structural levels or just basic levels in the market. So by this, that means that, for example, if we see prices pushing up from here, and this would be the entry we're taking. As I said, this is not a trade I am taking. I don't even trade this pair, but just for the sake of learning, say we see that we have a fresh major structural high here and we're looking to take buys. Now, this could then be used as a target. And the reason is because if we know that price often bounces from structural highs like this and it's a major region in the market, we don't want to be banking on price breaking that necessarily in order for us to get our profit. Because if we know price often bounces off these sort of regions, we don't know for sure that it's going to break and hit our target. So therefore, we set our target below that, and it's important to set it a bit below that because price doesn't always hit straight into these regions. We set our target just below these regions, and that's our profit target. It's based off structure of the market and it's based off levels in the market. These are the 2 ways that I would use. They are the 2 ways that I do use. As I said, just counting targets in pips, I don't think it's very good because it's very, very misleading and it doesn't actually take into account risk management on your account, which is one of the main ways of being profitable. So that is how we set targets, profit targets. Thanks for watching. Please like and subscribe. It's appreciated a lot, and I'll see you in the next video.